Welcome back. We're diving right into an analysis of Canopy Growth's Q2 fiscal 26 earnings, specifically the big EPS beat, and the question of whether they're finally near profitability.
And the analysis report gets one thing right out of the gate. This fundamental shift, the removal of the going concern risk.
It's huge, having cash and equivalents of what, 298 million CAD?
Right.
That's more than their total debt. It's the bedrock for any bull case.
It is. It sets the floor for the entire conversation. But, while the report really highlights that Q2 profitability narrative, I think there's a missed opportunity.
Okay.
It needs to structurally rebalance itself to really question the sustainability of all this. Because right now it feels like it's all about cost cutting, not revenue.
Well, the numbers driving the very bullish view are pretty compelling, to be fair.
They are.
A net loss of only 1.6 million CAD, that's down 98%.
It's a stunning number.
And the adjusted EBITDA loss is just 3 million? It all comes back to their asset-light strategy, and OPEX dropping 13% year over year.
And those are powerful metrics, absolutely. But here's the weakness in the structure. It presents these gains as if they're durable, sustainable, without immediately hitting the counter-argument that this is all masking a serious lack of top-line growth.
The analysis does mention the revenue miss, though, the $5 million miss.
It does. And it even says you cannot cost-cut your way to growth forever, which is the key insight.
Right.
But it's buried. It's way too far down. The reader takes a victory lap on cost savings before they even have to confront the real structural problem.
So the suggestion is about the flow of the argument, not the data itself. You're saying front-load that tension.
Exactly. Front-load it, make it crystal clear in the executive summary that this closeness to break even is a function of reduction, not expansion.
Okay.
That immediately frames the whole report as a debate about future revenue drivers. It becomes an investigation, not just an update.
I like that. So for a concrete example, you could right after you state that 98% improvement in net loss, you immediately bring up the total net revenue, 67 million CAD.
Yes.
And then you frame the entire piece around one question. Can the 6% Y over revenue growth actually sustain this momentum?
That's perfect. It forces the reader to grapple with the core weakness right away. It sets the expectation that this is about durability.
And here's another way you could do it. You could dedicate a section right up top to the gross margin.
The 33% figure?
Yeah, which is a mixed signal, right? It's down 200 basis points year over year, but up 800 quarter over quarter.
So why zero in on that specifically?
Because gross margin is a much more sophisticated proxy for efficiency versus pricing power than just OPEX cuts.
You can't cut OPEX forever.
Exactly. You run out of fat to trim. But gross margin, that tells you about your operational efficiency relative to your scale and what you can charge. The QOQ improvement is great, but the YOY decline, even a small one, combined with weak revenue growth, it suggests the efficiency gains might be temporary.
So putting that discussion up front immediately puts the burden of proof on the revenue side.
Which is exactly where the risk is. I think that's a very actionable piece of feedback for a rewrite.
Okay, so moving on, the analysis report does a good job delineating the bull case and the bear case. The clarity is a strength.
It is. But let's talk about that structure again.
I think the structural separation, putting them in two neat little lists, actually dilutes the weight of the growth drags.
How so?
Because these aren't just future risks. They're active, ongoing problems that directly impact the forecast for positive EBITDA.
Right. Let's just review them. We have the international cannabis revenue just cratering, down 39%.
European supply chain issues, a mess.
And then Storz & Bickel, which is usually a cash cow, their vaporizer revenue fell 10%.
Because they haven't launched anything new.
And you contrast that with the Canadian adult use side, which was up a massive 30%.
And there's the weakness. By putting those bare points in a separate list, the report doesn't really connect the dots. It doesn't explore how that 39% international drop directly threatens the Q3 or Q4 forecast for positive EBITDA.
It makes the Q4 break-even sound more like a sure thing.
Exactly. It sounds less conditional, maybe a bit overconfident, given how volatile those other segments are.
So the suggestion is to stop treating them like a risk checklist and start treating them like immediate, quantifiable obstacles.
Precisely. Weave the international weakness and the S&B slowdown directly into the analyst consensus and forecast section.
You have to emphasize the conditionality of that Q4 target.
Yes. If the report is going to argue for a Q4 positive EBITDA, it has to immediately say, here are the things that could stop that from happening, and here's how big they are.
So a concrete example would be when you mention the Q4 forecast, you explicitly qualify it. You say something like, achieving this hinges critically on mitigating that 39% drop in international cannabis revenue.
Right. That quantification makes the forecast more robust because the reader knows exactly what has to be fixed. It shows you've done the homework on the downside.
And you can take it a step further. This is where the analysis can really add value.
Scenario analysis.
Yes. Do some specific quantitative scenario analysis.
Okay, walk me through it. What would that look like in the report?
Let's take stores and Beacle. If that division keeps slumping at this 10% rate,
Okay.
the analysis should then ask, how many millions in extra revenue does the Canadian segment, with its 30% growth, need to generate just to plug that S&B hole and still hit the Q4 target?
That sounds like a heavy lift for the Canadian market.
It is, and that's the whole point.
Right.
It shows the investor how fragile that projection is. The Q4 break-even isn't a date on a calendar, it's a conditional equation that management has to solve. The analysis should detail the variables.
That's the kind of depth a high-quality financial analysis needs. Okay, let's pivot to the conclusion, the actionable insights. This brings us back to structural alignment.
Right, a running theme here. The actionable insights section is great. It outlines the conservative versus aggressive trading strategies.
Very valuable. But I think its positioning is off. If you put that dual framework much earlier, you align the entire analysis with the reader's immediate investment goals.
So, the report details the two strategies well. The conservative one, just wait. Wait for 1 quarter of positive EBITDA, probably Q4, before you buy in.
And the aggressive one?
The aggressive one frames the stock around $1.21 as an attractive lotto play. The downside is capped because bankruptcy risk is officially off the table.
Okay, but I see the logic of saving the action for the end. If you put the strategies up front, won't you confuse readers who haven't seen the data yet?
Doesn't the data need to justify the strategy before you present it?
That's the structural gamble we're suggesting, and it's all about maximizing impact.
Okay. As it is now, the reader absorbs all this data cache, OPEX cuts, the EPS beat, before they understand why it's crucial for one thesis versus the other. They're reading without a filter.
So you give them the filter first.
You give them the filter first. You pivot the whole structure. The removal of the going concern risk isn't just a fact. It's the justification for the aggressive lotto play.
Ah, I see.
And suddenly, every data point after that, the cash pile, the cost cuts, is seen through that specific investment lens. The reader's goal shifts from what happened to which path is for me and how does this data help me decide.
So you use the removal of going concern as the inflection point. That's the catalyst for the aggressive trade.
Right. And you use the need for confirmed positive EBITDA as the driver for the conservative trade.
And that gives every single data point a defined role.
Exactly. You make the data work harder for the strategy. For instance, in the Cash is King section, you can explicitly state that the $298 million in cash is the fundamental basis supporting the $1.21 price and justifies the aggressive play.
You're turning an accounting metric into a trading signal.
You are. And conversely, you use the analyst consensus hold rating and the desire for positive EBITDA as the justification for the conservative approach.
Linking it directly to that Q4 forecast we talked about.
It makes the entire analysis a strategic decision tree, not just a list of earnings metrics.
I agree. That structural alignment is the key to maximizing the impact here. The underlying material is strong, but these adjustments make the logic flow match the reader's ultimate goal, making a smart choice.
Absolutely. The data is top tier. This is all about refining the presentation. So, to recap the 3 main actionable suggestions we've covered.
First, rebalance the profitability narrative. The report has to more aggressively confront the sustainability question. Is this about cost cuts or real revenue growth? That tension needs to be right in the summary. Second, integrate the segment weaknesses, that international drop, the S&B slowdown, directly into the Q3 and Q4 forecast. Use scenario analysis. Make the break-even timeline conditional and realistic.
And finally, that big structural change.
And finally, bring those conservative versus aggressive trading frameworks to the front. Aligning the data with the reader's investment decision from the start makes the whole piece functional and immediately useful.
This analysis is built on a really high-quality foundation. The data's solid, the narrative is accurate. By implementing these